Good afternoon, everyone. I'm going to give it a couple of seconds while everyone comes into our room and joins the session. Good afternoon to you, Mike and GB. Thanks for joining me again. All right, let me go ahead and share my screen. I know it's scary. Sorry, everyone.
You're good, Lauren. Go ahead.
Thank you, Mike. Good afternoon, everyone. My name is Lauren Simpson. I am with the SBDC, or the Small Business Development Center. We are a national program with over 1,000 locations throughout the country. So that means that regardless of what state you might be in, you are able to get in contact with a local SBDC office. And you'll want to do so because we offer no-cost services to local small businesses. And they're at no cost to you because your tax dollars have already taken care of our fees. So you might as well partake in our resources. For the Los Angeles network, which is the network that I represent, we have locations throughout the Los Angeles, Santa Barbara, and Ventura counties, and you can see those represented on the map in front of you. You'll notice we're as far out as Camarillo over to Santa Clarita, Pasadena, all the way down to Long Beach. So if you are in any of those areas, please be sure to get in contact with one of our offices. Again, you'll want to do so because we offer no-cost business advising. And so you're able to meet one-on-one with one of our business experts in topics of taxes to finance to marketing, business planning, whatever it is that you need along your entrepreneurial journey. We have resources for you. We also offer virtual trainings, much like the training you've joined today. So again, we are here to help. Contact us to get started. Our phone number is 866-588-7232. Again, that's 866-588-7232, or you can reach us online, smallbizla.org/new client. And then for those of you who are outside of the Los Angeles area, please reach out to americassbdc.org/find-your-SBDC. So I'm sorry, everyone, my presentation has gotten stuck. Let's see if I can launch this again. I wanted to share with you all that we are a part of the, that our Dream Fund training program has opened. So for those of you who have gone to our website and have signed the registration form, please be sure to check your email because you should have received a note from us. I'm going to just end it. I'm sorry, everyone. You should have received a note from us that speaks to the opening of our new tracks. So again, if you've already registered or signed our registration form, which is found at smallbizla.org/dreamfund, you should have received an email. I believe it was 2 nights ago. If you have not, please be sure to send me an email and I will follow up with you. I'm going to include my email address into the chat. And then finally, one last note on that. The Dream Fund program is for businesses who are completely brand new. So again, Dream Fund is for brand new businesses, and it's a micro grant program that is offering grants of $5,000 as well as $10,000. So again, more information, you can go to smallbizla.org/dreamfund. And then finally, we are pleased to offer this event through the Community Navigator Pilot Program and the U.S. Pan-Asian American Chamber of Commerce. And I'll be sure to include information related to that program as well. Quick housekeeping, please be sure to put all of your questions into the Q&A. Again, questions into the Q&A. The chat will be reserved for any links that we need to share or would like to share with you, as well as any notes or any resources that we need to provide for you. And with that, I'm going to hand it over to GB and Mike. Thanks, guys.
Thanks, Lauren. One other point regarding any comments, please keep the comments and questions to the topic at hand. Otherwise, we'll be referring you to an SBDC advisor or another professional advisor because our time is limited and we want to focus on the topics that we're covering today. We will be covering how to properly set up your accounting chart of accounts and your accounting files. And with GB's help, we'll be taking a deep dive into this. Let me go forward. I'm going to go ahead and share my screen. Oh, before I do that, GB, you'd be interested to hear this. I had one client this morning, who started an LLC last year, selling online clothing. First question, did you file your tax return yet? No. Did you file an extension? No. Why not? I'm afraid. How many times have you ever heard this?
Many times. And this is why it's, I respect people's fear, especially when somebody's starting out brand new. They have no idea. And a lot of people fear the IRS. And I always gently remind them, being tax non-compliant is a criminal offense and not paying your tax is a civil offense. So although there is genuine fear out there, either themselves or someone else should do the proper compliance to avoid any criminal liability. So there's still hope for this person, but yeah,
tell them to file an
common
extension.
Yeah.
Otherwise, it's tax evasion. Tax evasion
Exactly.
is a serious offense.
Yeah. And not paying your taxes is a penalty of 0.5% per month. Not filing an extension, not filing on time, the penalty is 5% per month. So it's 10 times more. So that's why it's always a good idea to do the compliance. And unfortunately, it's a common concern that I hear out there.
So point, if you have not filed your taxes or have not filed an extension, do it. Do it as soon as you can.
Indeed, indeed.
Okay, so with that, let me go ahead and share the screen. 1 minute. So I'm going to take our approach to this presentation a little differently than what some of you have seen before in terms of accounting basics. Normally, when you go into an accounting workshop, GB's been to many of them, they'll talk about debits and credits and balance sheets and income statements, and you kind of get lost in those discussions. So I'm going to take a little different approach to this. All right. So the first question that I'm going to ask, I don't know about you, GB, aside from how much money you have invested in those basic questions, is what are you selling? Either it's a product or a service. And if it's a product, you should identify, and there's rules that GB can go into regarding inventory. You should identify specifically what you're selling, so you can keep track of it if it's a product. There's something called SKUs, stock keeping units. You can see an example here for a polo shirt. It's POL SHSL 38 blue. That means something to this company. So when they go and scan it or count it, they'll know how many blue slim fit polo shirts they have that they've sold and that they have in stock. Okay. So GB, I don't know if you're advising this for your clients. Are you?
It depends. Unfortunately, a lot of people don't have the human resource power or the technology power to set up the SKU. It is something I always encourage them to get towards as much as possible because it makes inventory management easy. It makes, or simpler, it makes accounting simpler. And it is, if they are ambitious, it is something they should do as soon as possible. It may not be on day one, maybe not in even year one, but as soon as they become more serious, and if they have to borrow money or save money out of their profits, it is something to invest in that will pay huge dividends in the long run.
Right. Now, there's also product families, there's product service, product families, product lines, and SKUs. If you can at least categorize it by a family or a line, that would be helpful. You may not be able to get down to a SKU. And for those those providing services, it's something similar. So this is a product hierarchy that someone might have. So they have a product family of perfumes, dairy, wines, and a bakery, right? Different types of products being sold. And then within those product families, for example, within dairy, you could have ice cream, yogurt, and milk. They could actually have 3 separate product lines: ice cream, yogurt, and then milk, right? And then under yogurt and milk, they have milk, classic yogurt, and smoothies. And then for classic yogurt, maybe they have different flavors. So they've identified their SKUs by a number. This would be a typical product hierarchy. I recommend that you do this if you're selling a product at some level. in order to make it easier to track your cost, track your revenue, track your inventory. Now, if it's a service line, service business is a little different. Okay, in this case, this is a digital marketing agency. So we have identified different service families. So there's development, communication, digital services, and what I put into other. And under development, you have web design and development, mobile app development, and SEO. On communications, you have email, social media marketing, content marketing. And digital marketing strategy, digital advertising, digital marketing analytics. And then you have some other categories like creative design and e-commerce marketing. The point is, you should set up your revenue structure, and I'll have GB talk about this, such that you can clearly track your revenues as well as your costs associated with these service families and lines. GB, you want to add to that?
Absolutely, because I was taught you never tell your business what business you're in. Your bookkeeping tells you what business you're in. If you have multiple product lines, you have multiple service lines, and you track your revenue and expenses accordingly, it allows you to determine where you can afford to lose money, your loss leaders, and where you're actually making money. So once you have limited resources, where should you allocate your time and energy and money to grow your business? In my profession, we offer many different services to our clients. And on some, we make money, some we lose money, and on some, we have the healthiest profit margin. So this family of business allows me to make better business decisions so that I'm not just blindly throwing money into my business products and services.
Perfect. Thank you. So that was one of the first points I wanted to make. Identify what you're selling in particular categories. Now, we're going to move beyond that. Once you've identified what you're selling, there's something called the sales to order to cash cycle. You want to prospect for leads. You want to initiate contact with those leads. Those leads can come through various sources, through your website, through signage, through ads in a newspaper, through personal networking, cold calls, leads through salespeople, reps, manufacturing reps. There's all sorts of ways to prospect for leads. You might get email lists, have a CRM system, customer relationship management system. Every company needs a feeder, okay? So GB has a lot of referral sources, and people refer clients to GB, right? People refer clients to SBDC. Go ahead, GB.
I was just agreeing, nodding with you. I've nothing to add. Thank you.
Yeah, there's numerous lead sources that you can access if you wanted to prospect, right? But after you prospect, you have to initiate contact. So there has to be some way of approaching those people. Maybe it's a flyer, maybe it's a capability statement, maybe it's a phone call, maybe it's an invitation to lunch, maybe it's a coupon in the mail. Somehow or other, you're initiating contact, right? After you initiate contact, you identify these needs. And this is something that GB is doing daily because he's talking to clients on a daily basis. What we're doing daily, right? Identifying your needs. What is it what's the problem you're trying to solve for that client? Then you present that offer in a particular way. You can't present the offer unless you know what you're trying to solve. Now, if you're selling a retail product, well, like a body care product, well, obviously there's a need already identified, okay? But you still have to offer that product in some way, shape, or fashion. There might be some objections as you're negotiating or speaking to your client, potential client, and then you close the sale. Now, I'm not real good at closing sales. That's why we have salespeople, and there's some very good people out there that can close it. They're worth the weight in gold and then some, okay? And then you repeat the sales and referral process. By the way, GB, do you have a separate department or person that is prospecting for you?
Yes, not a department. We have one person who handles all the leads that come in, and I'm usually the closer.
I believe it. Okay, it's a skill, absolute skill. It can be trained, okay? So this is the sales cycle. As part of the sales cycle, you identify what you're selling back to the product family, service families, and you record those transactions as you sell them, okay? There's the revenue cycle. After you prospect for the leads, you close the sale, you take an order from the customer. You process that order. This is all should be done in your accounting system, in your MRP system, your ERP system, in your sales system. You process the order, you prepare the invoice, you deliver the goods or the service, the customer receives the goods or the service, you record the transaction of that delivery. The customer should also be recording transactions because it should be a match between what you're delivering and what they're recording, okay? You get payment and it repeats itself. Now, when it comes to e-commerce, everything might happen simultaneously. So you're getting the order and you're immediately sending out the product with the invoice. But this cycle continues over and over again with your customers. GB, anything to add to this?
No, and this is the Achilles heel for many businesses. A lot of people brag that I wear multiple hats in my business. And 10 years ago, when I started my practice, I was able to run on all of these bases and hit a home run. But as the business grew, and as many businesses grow, if those processes are not formalized, or if additional human resources are not put in, basically hiring, whether you have independent contractors, whether you have employees, if it's not done, this is why most businesses fail, because after a while, it's no longer fun, it's overwhelming, people burn out, and the quality of their product or service diminishes, and people move on to somebody else. I've suffered through that. I had to recover from that. So it's always good to keep that in mind. You can only run so many bases, and after a while, you need help, technology or human resources or elimination.
Great. Let me go back to this. This is a key function for owners. You heard GB say he closes a sale. That's a high value add activity, right? Without the sale, there is no business, okay? The lower value functions should be handled by clerks and other staff members. Owners do deals, workers do tasks. If you're a three-man shop, find the person that is best at closing that sale and put that person to work and let them do it, okay? And let somebody else handle all the back office stuff, because that's where the highest value is, okay?
Add something to it real quick.
Yeah.
The one mistake a lot of businesses make is thinking, oh, closing and prospecting is the best and everything else doesn't matter. If you're just prospecting and there's no closing, there's a problem. And if you're closing and you're done closing, there's no prospecting, there's a problem. But everything else in between, that's where customer retention happens. So this is where sometimes some business owners, they make the mistake of thinking, hey, I'm the breadwinner and everybody else is expendable. They may be, but if they leave you, you have to rebuild that cycle every time, and it's expensive and time consuming. So the point being, value each component of your cycle. Is like making a fist. A fist is only as strong as a pinky. You take the pinky away and the fist is no longer as strong. So I always encourage my clients to value every component, small or large, of this cycle.
Great, great point. But don't get bogged down into the tasks, right? Leave that for others, okay? Now, so this is the task stuff, right? Processing the order, preparing the invoice, delivering the goods, recording the payments. It's important to process this properly, get the order right, get the transactions recorded, get the payments in. But this is a lot of task-oriented work that others can do. Now, once the order is placed with you, you're going to get payment. So there's an order to cash application process. This is especially true when you have accounts receivable. Again, if you're on e-commerce and taking payments automatically, then it happens simultaneously, okay? But, you know, many companies will take an order, they'll fulfill that order, they'll deliver it, they'll pick it, they'll pack it, they'll ship it, they'll invoice it, their receivables will be created, then there'll be a collection process. They receive the cash in and they apply it to the invoice, okay? So this is a typical customer order to cash cycle. You need to understand this cycle. The other graphic is is another version of it, okay? This happens every time you sell an order. And if you don't record your transactions properly at each step of this way, you got a problem. If you don't record the proper amount of products delivered, or you don't record the service delivered properly, you got a problem. If you apply the cash, well, I want to talk about cash application, GB.
There's something in accounting called the matching principle. The cash application has to happen depending upon if you're cash basis or your accrual basis. And the expenses follow suit accordingly because, for example, a common thing I hear from people, hey, I received the money, I received the check, their cash basis accounting company, and they say, I'll just hold on to the check until January 1st. It happens, and there are consequences, good and bad, of that. But depending upon your cash application process, whether you're accrual or you are cash, can have and will have a huge impact on your financials. So people often ask me, what is better? It depends. It depends upon what you're trying to accomplish, and that determines your cash application process cycle.
Right, but once you apply the cash, make sure you apply it properly. Don't apply the cash to the wrong customer. Then we get a real problem. Or don't apply the cash to the wrong invoice. Yeah.
Correct. Yeah. I see that happen too, and it's hard to collect on that afterwards.
Or don't bill to the wrong customer. Don't deliver to the wrong customer. Right. Don't take the order in from one customer and deliver the service of the product to a different customer. Now, most customers are, I have found out, are honest and will return it, or they'll take care of it. But get things right, okay? Now into the expense cycle, the procurement to payment cycle. This graphic is really meant for a larger company, and I've worked in those larger companies where you have to fill out a requisition. You want to buy something, you want to buy a stapler, okay? You have to fill out a requisition, okay? You have to go through an approval process through your supervisor. Then a order is created, a purchase order, right? The order is sent off to the vendor. The vendor ships it has to be approved. The order has to be approved. But then it's received from the vendor. Then a bill comes in from the vendor. The invoice has to be checked. There's a matching between what was received in the purchase order, and then a payment is made. Okay, that's a typical procure to pay journey. Now, for GB, you want to talk about this for smaller businesses?
The smaller businesses, it depends upon.
You're muted, GB.
Can you hear me now?
Yes.
Perfect. So for smaller business, it depends upon the sophistication of your vendors as well, because if you are dealing with a large vendor, they may require requisition. A small guy or girl or somebody running a business, they may just say, hey, give me a phone call, drop me a text, and that's your requisition. But nevertheless, your procurement process should depend upon your ambition level for that year and for 18 to 24 months to come. Because today you may be buying everything for your business. You may be thinking 12 months from now, I'm going to hire somebody. And he or she or they may not have the same authority over your bank account as you do. You can write a check to anybody and everybody and you're good to go. It's your business. You're the boss. If you hire somebody, you may want to have a requisition process so that if you are going to sign on a check, you know what you're signing it off onto. So this cycle, even though, Mike, you're right, it is designed for a large business. Sometimes you want to have these processes incrementally built for your business so that you can grow and you can dig your well before you get thirsty.
Right. And this is the control process, right? So you put the requisition in, you issue the order. When the receiving comes in for the product, or whatever, it could be a service, you need to be sure that what you received matches what you ordered. That's a control step, right? And then when you get the invoice, you want to match that the invoice matches what you received. And then when you show the payment, you want to make sure the payment matches the invoice, which matches what you received. And this applies to services. It's not just products. Okay.
Yeah.
Go ahead, GB.
And the control process also allows you to negotiate better terms with your vendor. Because if you act big, your vendor will treat you like a big business, and you can negotiate good terms. Because my dad taught me, you make, especially in a goods business, he was I'm in a service business, he was in a goods business. You make your money when you procure your stuff, whether it's inventory or goods and services for your business, because that allows you to expand your profit margin. If you don't have a control of your requisition and your procurement process, you have no idea where you may be leaving money on the table. You have no idea how to negotiate better terms with your vendors and your suppliers, and you may be overpaying, which means less money in your pocket. So always build a system before you grow. Otherwise, there will be tons of growing pain.
Right. And what we're not getting into right now is, okay, how do you set up a purchase order system? So if we're ordering products, there should be line items established in your system so that you know exactly what you're ordering, right? And you might actually have standard costing associated with that. We're identifying costs associated with particular items especially when you're in a manufacturing environment. I'm not going to that level of detail, but the expenses need to be properly recorded. Okay. And if you're in an accrual based, GB, talk about the accrual versus cash expensing.
Accrual versus cash, just like in the revenue, means when are you allowed a potential recognition of expense and the deductibility. So cash basis, a client pays you, you're going to pay taxes on that. And you pay somebody, you are going to potentially take a deduction, cash in, cash out. Whereas accrual says the moment you write an invoice, that is potentially taxable income for you, even though the client may not pay you for 3 months to 6 months. But by the same token, the moment you incur an expense, maybe on a credit card or maybe on credit from your vendor or your supplier, you are allowed potentially a deduction for that expense. And what is better? Cash is simpler but inaccurate. This is why for those of you who may be growing and you look for a larger loan, even though you may be doing your bookkeeping on cash basis, your taxes on cash basis, you will be required to do GAAP, which is generally accepted accounting principle financials, and GAAP does not allow cash accounting. Also, if you're running a goods business where you have inventory, you may not be allowed. There are a few exceptions, but you may not be allowed to use cash basis. You have to do accrual basis. And there are a few other exceptions where if you cash is easier, but because it's inaccurate, a lot of times you're precluded from using cash because of what you're trying to accomplish. So this is why I usually tell my clients, if they are going to grow fast or if they're ambitious, accrual is a better way to go.
Thank you. So with regards to this particular graphic, if someone's on a cash basis, the expense occurs when the payment's made in this last circle here, in this last graphic. But if it's an accrual basis, the expense could occur when the order is created or when the product is received. It depends, okay? Or possibly when the order is approved. But it's done before the payment. Okay, and in the other graphic where we have the order, this graphic here, when the payment is received, that would be on a cash basis. But when the invoice occurs, that'd be on an accrual basis. So you can see the timing difference between accrual and cash. Okay.
And may I add one thing to it?
Sure.
And could you go back to the procurement cycle? Yes. Yeah. A lot of times my clients ask me, so GB, you're telling me it depends under accrual basis, when is something deductible at order creation or approval or invoicing? It depends upon the terms you're negotiating. I always remind my clients, your purchase orders and your invoices are deemed to be contracts under commercial law and also under tax law. So depending upon what terms you're putting on a purchase order or an invoice determines when and a liability or an income or an expense is recognized. So give you an example, most states and most contract law determines when did the title or the possession pass to you. So if you're buying something, you create an order and your vendor says, all right, this belongs to GB now, either legally or in effect, the title passed to me, it is my liability. I can, under accrual basis, I can deduct it, I can do a lot of things with it. Or if it is possession, so it may not be, the title may not pass, the title may pass at deliveries of possession changes. So these are the nuances that as your business grows, you may need to be aware of, because you may think, I can deduct this right now. And the IRS may say, nope, we looked at your purchase order, you should not have. Or you may think, I don't need to recognize as income. The IRS, if you get audited, or even the California may say, nope, we looked at your invoice, the terms you put on your invoice, you should have paid taxes on this. And you did not, you underreported. Here's the interest and the penalties on top of the tax. So be mindful of what terms you put on your purchase orders and your invoices.
Great points. Thank you. Now, some of you have employees. You understand you have to pay your employees, that it's required by law. If you don't, serious problems, right? So in order to pay employees, you need to set up an employee system, a payroll system, human resources system. You need to register with the EDD, get a payroll service possibly, but you certainly need to record the payroll activity in your accounting system. And once again, there's a payroll cycle, right? First of all, you have to set them up in your accounting ledger, right? You have to set up the pay cycles, set up the employee, set up the work cycles, set up earning codes. You want to talk about earning codes?
Earning codes basically means, how are you paying them? Are you paying them by piece? Are you paying them by hourly? You're paying them under what job title, under what job description? Because earning codes can also affect your workers' comp policy rates. So earning codes are very important, just like make codes when you do many of your bookkeeping and accounting.
Right, and be careful about your pay cycles too, your pay periods. So I've worked for various companies where the cutoff was like a Monday and you didn't get your pay until Thursday, sometimes a couple of days. And if you're on an accrual basis, that has a significant impact on when you accrue versus cash. It can get complicated, okay? Make sure you set up the proper leave types, because if you have employees, GB knows you have to give them leave. You have to give them holiday pay. You have to possibly set up some sort of benefit plan. All the stuff needs to be set up properly. You have to set up the tax codes, and there's lots of taxes associated with employees, okay? Get professional help. That's what the payroll service is for. That's what folks like GB are for. Get professional help. Okay?
Yeah, and one thing I'll add to that, be careful. Be careful where you hire your people, especially right now, since a lot of people are working remotely, because we have federal employment law, we have state employment law, we have county employment laws, and we have city employment law. And a lot of times they contradict each other. And people often ask me, GB, if they contradict, which one do I follow? The answer is, you always follow the one that most protects or benefits your employee. So for example, California minimum wage, $15. Some counties, some cities in California, like in San Francisco, have a higher minimum wage rate for their city. So if you have an employee working out of that city, because either you're expanding or they're working remotely, guess what? You have to pay them that minimum wage. You cannot just say, well, California says this. It doesn't matter. Also, by the same token, as Mike mentioned, benefit, days off and all the other benefits, you have to offer benefits as prescribed where the employee is working out of, not where you're set up. So San Francisco, again, another prime example, if you're in the IT business, San Francisco has some of the most liberal employment benefit laws, which supersede California laws. So if you hire somebody in San Francisco, or if one of your employees moves to San Francisco, they're working out of there and you're in Long Beach, doesn't matter. San Francisco is more liberal, far more employee friendly. You have to comply with San Francisco law when it comes to employees.
That's also true for the way you classify employees. Now, I'm not talking about independent contractors versus employees. I'm talking about the classification of particular workers. You can't have one general category that says warehouse employees. I mean, it should be broken up a little bit more than that, right? You can't have just one classification that's just the office staff. Because workers' comp is dependent upon how you classify workers. And there might be legalities associated about the way you classify particular workers. GB?
Yeah, absolutely. I mean, you could have warehouse employees and one is pushing paper and the other is pushing a heavy load, two very different codes, very different liability. A paper falls on you, maybe a paper cut. A box falls on you, you may lose a limb or your life, very different liability.
Right. Job descriptions are different. The compensation is different depending upon the classification of employees. So don't just have one category that captures everything. Break it out. Speak to specialists about this stuff. All right. So there's a payroll cycle. It's all about cycles, right? Sales cycle, order to cash cycle, procurement to pay cycle, and a payroll cycle. And you've all had payroll. You all know what it's like. You record your time. It goes to HR payroll processing. They verify the data. You get the paycheck, deductions come out, and it goes to health insurance or taxes or whatever else those deductions are for, right? The point is, set up your cycle properly. Make sure that the time and attendance is accurate. Make sure the input is accurate. Start with the correct input. If you don't have the right social security number for an employee, if you don't have the right name, I've run into situations where people shared names, exact same names, and people got the wrong pay because the person set up the payroll didn't recognize it's two different people, okay? Or their accrual was wrong. One person got their accrual for vacation when the other person didn't, and it was a mistake. It's been corrected, but make sure everything is accurate. This is where accuracy counts, especially when it comes to payroll. GB?
Not only taxes, I mean, not only payroll, it affects their eventual taxes. I had to do with a client last year. I think I may have mentioned it before. Father and son work for the same company. The only difference is junior and senior.
Yeah.
One of the persons missed it. One of the two had a lot of tax problems. And because the payroll company missed it, it commingled their tax issues and
Yep.
it was a nightmare to sort it out.
And the Social Security reporting is wrong. Vacation accrual is wrong. Amounts paid for various purposes is wrong. It just everything has to be redone and corrected and amended return. So get it right from the beginning. Now, there's the accounting cycle. This is meant for a business which is a little bit larger, but there's an analysis of the transactions that occur, just typically happens in a month, okay, throughout the business. Then journal entries are created. Journal entries are created because not every transaction is captured through the payroll cycle, the sales order cycle, or the procurement to order cycle. For example, something called accruals. GB mentioned earlier that if you take a delivery or a product or you have a purchase order, you haven't received that invoice, maybe it's a service, you should still record the expense as an accrual. But you don't have a bill, you don't have an invoice yet, okay? You should still record that expense. So you might make it as a journal entry, for example, and you post it to the ledger accounts. This is the accounting stuff. Prepare trial balance, make adjusting entries. This is what accountants do, staff accountants do, and bookkeepers, right? Prepare the financial statements, close out the transaction letter. The next step is to review the financial information. Okay, you print out the financial statements, income statement, balance sheet, and you review it for strategic decisions, for history and future activity. So this is the accounting cycle. GB, I know you deal with this a lot. I don't think many of the folks that we're dealing with get involved in this.
They don't, and I usually encourage them to do so, especially if they are thinking of doing their own bookkeeping, because the step 2 here and the step 9 and 8 are crucial. A lot of people think that FreshBooks or QuickBooks or whatever books they're using will do everything for them. They won't, because one of the journal entries that we have to make is maybe somebody bought a laptop for $1,500 and they record it as an expense, or maybe rightfully they record it as an asset. Well, depending upon how they're using it and depending upon a whole slew of other issues, we have to depreciate the darn thing. And none of the accounting softwares at the elementary level right now, some of the higher end ones that cost $3,000-4,000 a month will do that for you, but you have to make the depreciation adjustment yourself. So if you have to provide your financials to someone, or if you have to do your taxes, you need to know how to depreciate the darn thing. And depreciation rules are different for the IRS, for GAAP, and for each state that you may be operating in. So at the very least, you may need to have 3 sets of journal entries to account for that.
Thank you. There's one step missing in this here as well, which is the reconciliation. You should be reconciling your cash accounts, your bank statements, at least once a month, because you need to know where your money's going, how it's being spent, and how the money's coming in. And I've seen too many situations where people have gone literally years without reconciling their cash accounts. I don't know how I can prepare their financial statements, but that's a mistake. GB?
I've seen it happen too, and unfortunately, it's a mistake, and sometimes the financials may not be accurate, but what happens worse is if there's any sort of embezzlement or even any carelessness, a lot of times these business owners, they find out much too late, and there's nothing we can do at that point.
Yeah, if somebody's taking the money, then when it was months before, what are you going to do? Yeah, exactly. Okay, so now I'm getting into we're past the cycles, right? I want everybody to understand those cycles. Now we're getting into how do you actually set up your accounting system. So GB, you understand this in terms of the fiscal years versus calendar years. You want to go through this?
Absolutely. By default, everyone is expected by the state and the federal agency to operate on a calendar year, because W-2s have to be calendar year, 1099s have to be calendar year. But sometimes some businesses operate on a fiscal year because it is more conducive to their financial activity. So for example, maybe somebody's busiest seasons are in Q4. So that will be September, October, November, December. Well, October, November, December. So they may have a fiscal year starting on October 1st, ending on September 30th. If you want to choose a different fiscal year than the prescribed calendar year, you have to apply for a special permission, filing some special forms with the IRS to let them know, hey, don't expect a tax return from me every March or April. I will do it at a different time schedule because I am requesting to be allowed to be a fiscal year, because that is a better representation of my financial activity. And if IRS approves it, most states comply, and then you can use a fiscal year versus a calendar year.
Thank you. Some may be confused by this 445, 544, 454 scheme down here on the right, because we don't have 52 exact weeks. There's some days that don't exactly count to 52 weeks. Some businesses choose to smooth out the quarters by electing a 4-week, 5-week quarter, or 544 or 454. You're welcome to do that. It's called fiscal months. Okay. Quite honestly, I don't see many people doing that anymore. How about you, GB?
I only have one client who does that, and that's because they're a legacy client. It gets very hard, and your bookkeeping and your accounting has to be top notch. It's like driving a Ferrari. You're not going to go to Costco to pump 87 octane. You need 100 octane that will cost you $15 to $20 a gallon.
Yeah, I agree. Okay, so now we're getting into this topic of a chart of accounts. You've all heard of a chart of accounts. So what is it exactly? Okay. So a chart of accounts is the way you set up your accounting structure. And there are specific account categories. GB has previously shown us some balance sheet and income statement. I'm going to have him do it a little bit later. Okay. So you have an asset category, a liability category, and equity category in general. Those are categories that are attached or belong on the balance sheet. and you have income and expense categories, maybe some taxes, but basically income and expenses on the profit and loss or income statement. Okay, so just think about this in terms of categories. What belongs where? Assets, liabilities, equity belongs on balance sheet. Income and expenses belong on the income statement at its most basic level. Too many times I've seen people confuse income and expenses with asset and liabilities and vice versa. How about you, GB?
I see it all the time.
Yep. So you need to understand what goes with what. Now, typically a balance sheet would be broken down and organized in a particular way, and they'll assign a count number. So assets would be in the 100 series, liabilities in the 200 series, equity in the 300 series. And then the income statement would have various account number structures like revenue 400, expenses 500. Okay, this is a very basic simplified structure for a chart of accounts. Many systems follow a structure like this. Oftentimes, and I'm going to show you one, it can be much more extensive. Okay, but this is the basic model that someone might follow. As I told you, I was going to show you something that's much more extensive, right? This is for a much larger business where you have all sorts of accounts, and GB's seen this over and over again. So you have current assets and long-term assets and fixed assets and intangible assets, and GB can explain all those differences. But the point is, they're all starting, you see, they're all starting with the number 1, every single one of them, okay? And then you have the liability accounts. They're all starting with number 2. And then you have the equity accounts, they're all starting with number 3. This would be a typical structure. GB, you've seen this over and over again, right? GB, you're muted.
I have seen it, and I've seen some horrible chart of accounts, because one tip I'll share here with all the attendees. If you are setting up your own chart of accounts, be mindful. You don't need a chart of account for each item in your business. You're creating a chart of account for one type of thing. So for example, as you can see on here, you have inventory, which is 1,600. You don't need inventory for all the different classes. You have one inventory, and then there could be other accounting attributes to distinguish inventory. And one of the things I see is, for example, in expenses, a lot of times I see on chart of accounts, DHL chart of account. I have USPS, UPS, and I have FedEx. You don't need that. You need one shipping. And if you're using QuickBooks, for example, or even FreshBooks, you have a list of vendors. So if you ever need to run a report on how much money am I spending with FedEx, you go to the vendor list. You don't go to your chart of account. Your P&L, sometimes I see some P&Ls that are 20 pages long because they have a chart of account for everything. You don't need that. So be mindful as you set up your chart of account. It should be short and it should be concise, and it should tell you how to run your P&L and get a bird's eye view on your company's health. If you need more POV, more detail, there are other attributes of your accounting system that should provide you with that insight. Keep your chart of accounts short and sweet.
Now, having this particular chart of accounts was taken from a business doing like $15 million a year in revenue. Okay,
Wow.
So it's a little bit more complicated than the typical client would see.
Correct.
However, what I would say about that is, remember we said earlier, break out your product families. That you should segregate. Okay,
Indeed.
or service families. So that's why I see here product sales, 1 product. It could be 5 product families or product categories, or 10,
Correct.
but break it out. And then you can break out the expenses, the cost of goods sold associated with those product sales if you want. Okay.
Correct. And these should be
Now,
distinct, because it's not should be like, these are my subcompact cars and these are my luxury cars. This should be like, these are my heavy trucks, these are my heavy equipment, and these are my consumer cars. So if you're in a car production business, for example, then the product 1, 2, and 3, they are like big families, not the subfamilies. Otherwise it gets too confusing.
right. Now, in this case, we didn't do that. We just went to, when you're in a manufacturing business, you have direct labor, material and outside processing, and contract labor. Those are direct costs. That's cost of goods sold. If you're just reselling product, you're buying and reselling, the cost of what you're buying is your cost of goods sold. It just has to be recorded as you sell it. Okay. Then, you know, if you're in a manufacturing business or any other type of business, you might have a warehouse, you might have an office, there's overhead. And for a company like this, it's a manufacturing business, they have to allocate the overhead. This gets complicated. It doesn't have to be this complicated, but everybody has some sort of overhead, okay? And then you have all these expenses. Just categorize them. Now here we broke out auto insurance from health insurance from liability insurance. You don't have to, but maybe you just break out 2 basic categories of insurance.
And may I add one thing to it, Mike?
Sure.
If you're doing your own bookkeeping, watch a YouTube, watch Bookkeeping for Dummies, or not watch, read it, or just take an accounting class, because all of this stuff is rules driven. QuickBooks doesn't care. FreshBooks doesn't care. Any of these accounting systems, they do not care. They will let you categorize this stuff however you see fit. But you have to know, for example, if you are entertaining clients, some entertainment is deductible, some is not. Some are by state. So this is where if you're setting up a chart of accounts, don't just throw all the entertainment, don't throw all the meals into one chart of account. You need that distinction because, and this is where bookkeeping rules can change. Rules changed in 2020 because of the pandemic. Rules changed in 2018. These rules change periodically, and you may have to curate or prune your chart of accounts regularly. If you set up your QuickBooks 3 years ago, chances are you need to reclassify some of these things because things change. So it's not one and done. It's like working out. It requires, or more like gardening, it requires you to pull out the weeds and sometimes reclassify things to make sure you're running proper financials.
Great stuff. This just goes on to the next level of expenses. And you can see there's a whole bunch here. In this case, there's, you know, admin, payroll, human resources, payroll, et cetera. You may not have all those departments, but at least have a payroll account, okay? You know, there may be professional fees, lawyers, accountants. At least classify that out under professional fees. The point is, when you go to report your taxes, it should be classified properly to make it easier to understand in terms of what's deductible and what's not. You agree, GB?
I agree.
Right. Here we have a breakout of all the utilities. At least you break it out into one category. Okay. So I put together this little journey in terms of how to set up your accounting. First of all, you have to set up the company in the accounting. Whatever system it is, you have to set up a company. Okay. Doesn't matter if it's Wave or QuickBooks, whatever, you have to set up the company. You have to set up establish your fiscal periods that we talked about. Establish your SKUs or lines of service or product families. Set the prices for them. Because when you bill, you have to bill based upon a price associated with those product families or those services, right? Now that may change, but at least set something up. If you have inventory, I spoke to somebody today who's got a storage unit selling clothing online. He's got a little storage area. He should have set up a warehouse in the system, literally a virtual warehouse, and keep track of the inventory in that warehouse virtually. Determine your costing basis. I'm not going to go into a lot of the standard cost, activity-based cost, but there's some sort of cost associated with inventory. Determine your payroll cycle. If you have employees, add the employees. Add your customers as you get them, or if you already have an existing customers, add them into your system. Add your vendors as you issue purchase orders, or as you, if you already have them, put them in. This is an important one. Link your bank accounts to your accounting systems. Most accounting systems now will allow you to automatically transfer transactions into your accounting system, which makes it a lot easier to reconcile. And then there might be some third-party apps that you can attach to your accounting system, and talk to experts when you start doing that type of stuff. GB, want to add to this?
It's a lot to do. It needs to be done. And we have advisors at SBDC to help you with most of these stuff, or most of these steps. And it's time consuming. It's like digging a well. It's time consuming. But it has to be done. And I see a lot of times people skimp on these steps and they pay for it later on. So I'm not trying to scare you. I'm trying to encourage you. This is a great representation of what needs to be done. And it says add customers. It doesn't take 5 minutes. If you have, let's say if you're growing and you're adding 5 or 10 or 20 customers a day or a week, somebody has to sit down and enter them. CRMs, the customer relationship management systems, are great, but I have somebody spending the last 2 weeks in my business setting it up. It's a full-time job for that one person. I don't have time for it. So all of these steps are important. Somebody has to do it. And technology is great, but somebody has to put the darn data in before you can use that technology.
Right. Someone's asking about the difference between state and federal rules when it comes to tax deductions.
Oh, huge differences.
There's too many to go over.
Yeah.
So see a professional tax advisor, speak to an
Yeah.
SBDC advisor, and it's just too much to go over in this short of time.
And I work with a lot of clients at SBDC, so we can set up an appointment and I can walk you through it. But especially since 2018, the variances are huge.
Right. So with that, I'm going to stop the share. We've come to the end of the hour. So GB, that's it. I don't think we need to cover any more on that topic right now.
You did a great job, Mike.
Thank you. Thank you so much for your time. Thank you very much for joining us. We'll be back here next week. GB, I was thinking about this. Perhaps a couple of topics might be how to survive an audit.
Okay.
I want to consider that one.
Sure.
Yeah.
I'll consider, that's a little tough one because every audit is different, but I'll cover some topics on it. I think I did one presentation on how to avoid it in the first place.
Okay.
But if you are the unfortunate one who gets the letter, how to survive it, sure, I'll do one on that too.
Awesome.
Yeah.
Thanks so much. All right. I'll see you next week.
Thank you,
Bye,
Lauren.
everybody.
Thank you, Mike.